There. Okay. Can you see problem 3?
Yeah.
Okay, perfect. So looking this over, so let me pull up the problem for myself. Okay. So what I saw in chapter 3 in this homework was, okay. So we have the 48,000 excess over book. Cash paid was 360. So the net identifiable assets was 464 minus the 40,000 accounts payable and the 104,000 bonds payable, which meant it was 32,000. Cash paid was 36,000.
Yep.
Or 360,000 minus 320,000 was 40,000 goodwill.
Yep.
Okay, so that. Okay, so I went down here. I did. Let's see. That is supposed to be. Wait, hold on. No. Okay, so I did the. Okay, so credit, equity investments, negative 30,400 to as I, or should I go by letter? I don't know. Anyway, so that's where that one came from. The dividends,
You know, it's right here.
33.
I think any retained earnings should be the 590,400.
Retained earnings. 594. This is what should be.
The ending retained earnings under the consolidated totals.
Right.
It's 720,000. It should be 590,400.
Okay.
Those will be exactly the same as, you know,
Is that because
basically all this stuff is gone.
right? So this should be negative, or this should only equal. Wait, yeah. So, oh wait, is this supposed to be? I'm supposed to subtract out the 126,400?
No, it should be exactly like the parent company. The 560 plus.
Oh, it should be right here.
Yeah, and the beginning balance should be the same 590,400.
Oh, was I supposed to take out? Was it because I was supposed to take out the 129.60 from the bill company?
Yeah, that's all gone. That's gone.
Yeah, okay. So if that's only right, so then it would only be.
Yep.
Okay, so then that would be the 500 or 590,400.
Yeah, basically the only thing that's left is the parent company retained earnings.
Okay. All right. And then, okay, so we've got that minus the 8,000 for dividends. The 33,600 matches here and subtracts out. So that's why this would equal there. Okay. Okay, so added for the building, we added for the land, we added the 16,000 excess as well as the 32,000 excess, but also took out, we also took out the deduction for the 3,200, which also then went up here under depreciation expense because we depreciated the building for the 10 years, which was, you know, obviously at 10 years, 10% of the excess. And then what else? Okay. And then down here, we took out the, for the investment, we took out the 8,000 for the dividends as a debit. So here's where I think something went hinky. So I've got the 272,000 from the land. And then I've got the 88,000 that should be the 16,000, the 32,000, and then the 40,000 for goodwill. So the excess plus the goodwill is 88,000. And then I took out the 3,400 for the equity investment income, but I think that should zero out, and that doesn't zero out. So I felt like I did something wrong with maybe the goodwill, but the goodwill should be right.
I think you subtract. I think you subtract out the 8,000 instead of adding.
Okay, I'm supposed to add that. Okay, there we go. So then, here we go. Okay, I kept thinking the problem was that I was misunderstanding what went here in assets, but I was like, well, of course it has to be the excess plus the goodwill. Like, what else could it be? But I was like, but here I have this $16,000 I can't explain. Okay, so that makes sense then. And then, but then I do have, so I took out the common stock and I took out the paid in capital for the bill company. But these two should match and these two don't match. And I believe they should both be the 1,347,400.
Yeah,
but yeah, they don't match.
Retained earnings here down at the bottom should be the 590,400.
Okay, so it shouldn't have this. Oh, because I already took that out for the.
I
should have taken that out. That's right.
No, wait, go back. Put that back in.
I didn't do anything yet. Okay.
But the only thing that's left are the retained earnings are 590,400. So change the 720 for the retained earnings at the bottom here. Change that to 590,400.
So that should only be this column, not this column. Yep. That's correct. Okay. That should only be the any retained earnings. Okay. And then, is it because I took on because the total assets and liabilities should only be these two? Because these should all disappear. So the total liabilities and equity for bill company, should they only be the accounts payable and the bonds payable? Is that where my error is?
Yeah, exactly. The only thing that should be added on is that. Check the formula for total liabilities and equity.
Well, I mean, I just did. It's just this line, but that's not correct, right? What is the formula for the total liabilities and equity?
Adding up all these, adding up the just the totals here in the column up. Yeah, add those up and.
Oh, I shouldn't. Okay, I got what you're saying. Okay. No, I did that formula wrong. Hold on. Okay, so that's correct, which is good because that matches the assets plus the accounts payable plus the bonds payable. And then up here, I don't match, but I should. Was that because I was supposed to do?
You're supposed to add all those up, yeah.
Okay, yeah, I did. I just carried. Okay, there we go.
Go all the way to get the will. Too.
Yeah. Okay. So. And you even said last week that people forget the goodwill, and then it doesn't balance. It still doesn't balance.
Something funny
missing here. Let me try that one more time. I just formula. Oh, there we go. So now they match.
Yep, that's it.
Yeah. Okay, so is this correct? Is there something I'm missing here?
I don't think so. Let me take a look. No, that's fine. Now, just so you know, and I know why you did it this way, but when it comes to making journal entries, especially on CPA exam or something like that, don't ever put negatives in the.
Okay.
I know why you did it, so you can just add them up. So it makes
right.
But just in just
technically, they should all be positives, and I should be subtracting them.
Well, yeah, the debit or credit will tell whether it's plus or minus.
Right.
So you don't put minuses in the account. Now, I don't, it doesn't matter. I mean, I know why you did it, because it's easier just to add the column, the row, if you put in whether, you know, whether it's a minus or a plus.
Right.
That's fine.
Yeah,
Yeah,
that makes sense.
this is it. That's it. So this is, yeah,
All right.
very good.
Perfect.
Yeah, and the dividends, that is the weird one, because the dividends are the, because we subtract them when we're doing the equity method. So we're unmixing the cake, you got to add it back in. And that sounds strange because you're trying to eliminate the investment account, but you have to add that back in. But you're adding it back in because you subtracted it earlier. So that is, you know, it's kind of a weird thing about the equity method.
Mm-hmm.
That normally you think, okay, I'm trying to eliminate this, you know, we have to subtract everything. But that one actually adds in.
Okay.
Did you want to try another one of these?
Sure.
Round 4? You want me to shut up and?
Okay, you want me to try to do it?
Yeah.
Let's see. All right.
Share my screen.
Share. Okay. Let's see.
Or actually, I could. You can, yeah. Oh, the matter screen.
Let me. I'm gonna try doing it on my computer just for ease of addition. Okay, so let's see.
I'll be right back.
All right. Some. Okay. So, yeah. Okay, so. Okay. All right. So Goodwill. Goodwill. Asset. Okay, right there. Right there. Okay, I think I've got it.
Okay.
All right, let me share the screen. Okay, so buying the bill company, we've got 7,200 excess over book. Net identifiable assets is 69,600 minus 6,000 minus 15,600 equals 48,000.
Yep.
The cash paid was 54,000. So goodwill equals 6,000, 54,000 minus 48,000. So we add in the depreciation expense, which was 480 because the excess was 4,800 divided by the 10 years, depreciated over the 10 years. And then we take out the equity investment, the 4,560. So that should equal 4,550, or sorry, 456,360.
And stop you right there. The cost of goods sold and the depreciation expense will be minuses. You should come up with 18,960.
Okay, so I should be, wait, because I take out, oh, you're right. Okay, so I'm taking out, that's right. Because I'm, and then, taking out both of those lines. So 18,960. Perfect. Okay, so I'm supposed to take out both of these, but I don't want to put them as negative on the sheet, right?
Well, in the journal
on the CPA exam.
in the journal entries. Now on the financial statements, usually they are shown as negative, but in the journal entries you don't put negatives.
Okay.
I don't care if you do it in this, because I understand why you're doing it.
Right.
It's just to make it the Excel work easier.
Right. But I would like to pass the CPA exam.
Obviously, yeah. So the journal entries are always just positive whole numbers. I think they can really be pennies too. But the debit or credit will determine whether it's plus or minus. So if it's an asset and you debit it, it's a plus. If it's a credit, you minus it. But you don't actually put the pluses and minuses in. Again, it doesn't bother me.
Right.
On the spreadsheet, because I understand why it does make things easier. Put them as negatives, but just note that you don't put those in.
Right. No, definitely. Journal entries are always positive. Okay, perfect. Okay, so then we've got the okay, so bill company, we're taking out retained earnings as a debit, ending up with 84,000. We're not counting the net income. And we're taking out the dividends. So that should be 88,560.
It basically should be exactly like is in column C. Column C is exactly what should be in column I.
Right.
Yeah. All the other stuff in the subsidiary is gone. All the retained earnings are gone.
Right. But we don't put anything for the five. We don't put anything for this. We don't because this has already been taken care of up here. For the 5,040.
Correct. Yeah, and then it's a little bit confusing because net income appears on two statements and retained earnings appears on two statements. So it does become a little bit confusing, but just you just have to kind of keep in mind that, okay, this is gone. This is not there anymore. So the net income's gone and retained earnings are gone.
Right. So it doesn't matter that I'm not taking them out on the actual statement of retained earnings.
Nope, those are already gone.
Okay, for the balance sheet, we're adding the 2,400 for the land and the building 4,800 minus the depreciation divided by 10 years. Down here, we have the investment 57,360. We're taking out the this is the, make sure I remember this. This is the dividends, right? So we're adding in the dividends of 1,200, and we're taking out the the 480, which is the land, and the 1300 13,200 is the 2,400, 480, 4,800, and the goodwill of 6,000.
Yep.
And then up here, this is the equity and investment income that we are taking out, and that should all zero out.
Correct.
And then we add everything together, and it should be 206,160.
Yep.
Okay, great. And then down here we have accounts payable. So we add the first line, add the second line for bonds payable. Common stock, we take out the bill lines, and we take out the bill lines, and then come down to retain. So those are just the same as the Amy column, the 21,600 and 31,200. And then down here we have the retained earnings, and this is also just the Amy column because the 9,400 is because because that's on the retained earnings. That was the line under here, the retained earnings. So we've already taken those out, so that's why that's not there.
Right.
Even though it's not subtracted on this form. And then when you add all those together, those are 206,160. So they balance, and then they also equal total assets in the Amy column plus the bill column for accounts payable and bonds payable.
Yep. Yeah, and the
Perfect.
if you think about the entire equity section for the subsidiary gets taken out. It's all gone.
Mm-hmm.
Because there actually is no external ownership. I mean, they run their company as if it was, but in reality, when you're 100% of your stock is owned by the other company, there isn't any of this outstanding. There's only one thing I would say is, and that is on the dividends if you go up to the retained earnings section. This is a very minor one.
Yes. Mm-hmm.
Change the note from A to D.
Oh, great.
Now, and honestly, that's not really a problem at all because we're actually just looking at the journal entry, but just so you know.
Right. But yep. Yeah, but no, also, right, D for dividends.
Yep. Yeah,
makes sense.
Okay, well, do you want to do another one of those, or do you want to jump to a more difficult problem?
Let's do a more difficult problem.
Okay. Now, part of the reason is that these that I don't like some of these, well, most of the books in consolidations is that they don't really tell how to. It's through water over myself this morning. They don't really tell. It's hard to get a practice on doing the problems because they always do something different.
Right.
So, I like doing just straightforward problems so people get kind of a hang of it, and then we'll jump into the thing. So I think that's what we'll do. And I think, so there's text problems included on here.
Mm-hmm.
Let me share my screen. And none of these are really clean. And I say that because this one, 327, is a little bit kooky because it gives you information. These are the this is for 2018. It's 2 years into it. There's not a big problem with this, but there's a little bit of something with the assets. This one is a little bit kooky. This one kooky. I don't remember why this one. Oh, this one's kooky because it has The fair value of the equipment is actually less than the book value.
Mhm.
So this one's a little bit kooky. And this one is kooky because it has a bargain purchase. Which is a gain. So let's see. I think which one would be the. Which one would be the least headache to? Let's do problem 328. This is one that has a little bit less for the equipment.
Okay.
So let's do this one. Change all these. Why do these look so small? I'm gonna change the font down. I think I was trying to match the font to it. This is like a copy of it.
Mhm.
So let's see, this is yeah. Okay. Well, 100%. That's good. They paid $515 cash. I'm gonna put this on the side just because paid in cash. Somebody's called consideration. Is there a term for that?
Mhm.
All right. They said that reported net assets with a carrying amount of 350. So this is the book value. Oops, nice little book. 350. And we had some changes in the fair values. Okay, so this book. And one of the problems with these questions is just kind of figuring out what it all means.
Mhm.
When I was in auditing, I had a really good one of the guys that I had was a really good mentor, but you'd always say, you gotta get your arms around it. You gotta get so I start talking about something. Well, you gotta get your arms around it. You gotta figure it out before you start. So, okay, so trademark. Oops. Kind of kidding here. Let's see. That's my relation of 0 to the fair value. Okay, and so this is the excess. Now, it's, you'll notice that it's a little, the term excess does not really apply to all of these because this one is actually worth less. Oops. You know, this one is negative. You know, they're saying their equipment's worth 342,000. We say it's worth 312. Okay, and let's say years here. Trademark is not applicable. Customer relations is what? 5 years. And equipment is 10 years. All right, so let's see what the total excess is here. I should probably say net excess because it's really I mean, you put total's fine too. It there's a negative one. Okay. So let's see here. Let me move this down. Let me move this down. You're down too far. Okay. Okay, so the net assets. Identifiable assets. Okay, so net identifiable assets, excess assets. That. So the net assets be so this would be the net assets. You know, I realize I shouldn't put this net in here because that's gonna be confusing. To have two nets in there. You know, this is just the excess to, so excess identifiable assets, that's a negative, but so identifiable excess assets with that, net identifiable assets, these are not excess, these are all total assets. We'll leave that. Too much. Okay, so the goodwill, we would compare that. This is also called consideration sometimes.
Mhm.
Hopefully they spell it better than I do, but all right, so this is the net identifiable assets were 409. So the unidentified assets would be the goodwill.
Would be the 55,000.
Yep. Oops. Okay, so all right, so that's our goodwill. What else do we need over here? Anything? I think that's it. Now for the expenses here, though. So the additional customer relation expenses, I think those relations are going to last for 5 years. 15,000. Now this one, be careful because this is actually going to reduce our expenses by 3,000. Because in reality, we're only picking up the 312 on the equipment. You know, they're depreciating at 342, which is fine. There's no, if you know, if they're depreciating that straight line depreciation, yeah, it very easily could be more on the books for more than the fair value. Nothing wrong with that. Depreciation is an allocation, so it's you know, there's nothing wrong with.
So we would be depreciating 30,000 or 31,200 every year.
If now you remember that they're probably already depreciating. You know, they're already depreciating 32,400.
Right.
Whereas you're right, we should be depreciating 31,200, right? If we don't have the books, if we were to dissolve this thing, those coming out to be the same. Transposition here, 34,200.
Mm-hmm.
So the difference is that 3,000.
So 3,000. Okay.
So you know these two. You know, difference between those two will also come out with that same number. You know, they're depreciating this much. We're saying you should only depreciate 31,200. So we're going to take off 3,000 of depreciation. And again, this is a weird one. Not that would be unusual though. If they're depreciating on a straight line method, especially if they have newer equipment, you know, like a car. You know, if you're doing a straight line method, you buy a car. Well, the fair value of that car drops quite a bit in the first year.
Right. It's not a straight line.
Exactly. So it could very well be that they have assets on the books for more. Nothing wrong with that because depreciation is not really trying to get the fair value. It's just allocating the cost. So, you know, there's nothing wrong with it. Them having it on the books. It's not unusual to have, especially things like equipment. Usually for land and stuff, that really keeps going up in value. Equipment is usually goes down. Okay, I think we're ready to start.
Okay.
All right. So let's see here. Let's go to our, let's do the Sadie thing. I have
Mhm.
my Sadie. Sadie. All right. So Sadie. So we had to get rid of the stock. So retained earnings.
Mhm.
Then okay, so we have green. Okay, so the retained earnings. We have common, we don't have any additional paid in capital. Some states don't require it. So this will be 100,000. And investment 350, which is
Which is the net assets at book value?
exactly.
Okay.
Yep, exactly. Now, as I said, book value will be the exact same thing as the total equity section. Okay, so we got the stock. Assets. Okay, so the assets are trademarks were what? The excess was 100,000. What color should we make assets? Orange
Mhm.
color, and it's a fruit. All right, so customer relationships. $75,000. And here is where it gets kooky
Mhm.
because the excess is actually a negative for the equipment. So this will be a credit of 30,000.
3,000 or 30,000?
30,000 for the asset. Now when we do the expenses,
Oh, and then okay, I see what
but
you're saying.
it will be we will add back in basically 3,000
Right.
to it because they subtracted out 34,200 and they issued it. Well, if we had did it at fair value, it would have been 31,200. Okay, so goodwill. What was the goodwill? 55.
Yeah.
55. So we're going to add these three and then subtract them.
Mhm.
Okay, so that's our purchase price basically of the 550.
Is that how it always is?
Yeah. It just it'll be like that. Yeah, that'll be the purchase.
Okay.
Yeah, and if you'll notice that these are things that happen throughout the year. So this happens right at the beginning.
Mhm.
These down here happen as the year goes on. Dividends, income, and expenses.
Mhm.
Okay, dividends. Dividends declared, those are debits, so we get rid of those with a
Right.
80,000. And those are odd because they were subtracted out and now they get added back.
Mhm.
Okay, so we we're just sad. Now we got, hey, that shouldn't be the same color as those. Ah, oh well.
Mhm.
This formatting won't be on the CPA exam, so that's all right. So we got to get rid of the income. So there's the income.
Mhm.
So that's I. It is a credit. It's money coming in. So we get rid of the debit. By the way, that must have been one heck of an investment. They paid $550 for it and it had income of $210.
Right.
It's a very profitable company. All right. So that is the I. So now we're on the E, and these E's are whack. Now the customer relations will be the periodization expense.
Okay.
Um, 50,000. All right. Yeah. Oops. That's not bad. Like 15,000. All
So
right.
you're amortizing the loss of the relationships over the next 5 years.
Yeah, you're doing
Okay.
customer relationships and how long those last for. And those can be for a lot of businesses, the customer relationships or the customer list is the value. My
Right.
my neighbor, he worked like $100 a week. He had a lawn mowing service, a landscaping service, and then he also worked 2 full-time jobs. Anyway, he sold the lawn,
Gosh.
and he sold the landscaping business for quite a bit, but it's a customer list. I mean, the lawnmowers are worth a couple $100 or something,
Right.
but it's the customer list that was the value. So, and that's not uncommon, especially for smaller businesses with the customer list. Okay, so customer relationship. So this one's kind of say the usual.
So you're crediting the amortization expense and debiting the full amount of the 75,000.
Right. So put 75,000 on the books, and at
Right.
the beginning of the year, that's what those relationships are worth. But
Right.
we're writing those off. Yeah. All right. Now the wacky one, 3,000. So our expenses are too high by 3,000.
Mhm.
So we're not adding expenses, we're actually taking off expenses of 3,000. And notice that the subsidiary would have subtracted 3,000 more than we would. So we have to add back in the 3,000. Oops. So that one is a little bit strange. It's not, I mean, it's not the
Right.
outside the, there's no such thing as an ordinary cat. So there's no such thing as an ordinary business. They're all different.
Mm-hmm.
That's how soon Target is way different than Walmart. They're in the same business, but they're way different. Okay, so now we have to start moving them all over. Okay. So we're going to take both the sales together. Now this one, we're going to add these two and then subtract.
Okay.
Well, I can put those, now over here in the totals, you can put these in as negatives if you want.
Mm-hmm.
Those are the financial statements. Often you will see those. Okay. Amortization expense. Plus that. Zero. All right, now hopefully when we add this up, it should come out to the same 935. Yeah.
Okay.
And this one over here, I mean, you could actually just copy and paste those if you want. Because the income is gone. It's gone here. The dividends are gone. We can't. So these are all the results. So this is just 700. Net income would be 9. Declared dividend goes into the negative because they are subtracted. And by the way, you can look up here. You can kind of see where they get that. Brian reported 222,000, and our income from Brian was 210, but that's because of the 222,000, we subtracted out 15,000 and added back 3. Yeah. So
that's the 12,000 difference. Okay.
Exactly, 12,000. We had 12,000 more of expenses basically. So 22, so that's why they get the 210. Okay, down here. All right, hopefully this works. Let's see here. Plus the dividends. Look at that, you even got 80,000 in dividends in this one. And we can actually kind of check that number because that'll be our total assets.
Right.
Oops, too many S's in. Was 2664. And you'll notice that our liabilities, the only thing that, so these two sides have to equal. The assets have to equal the liabilities and equity.
Right.
The only thing that increases over here are the liabilities.
Right.
So the total assets should equal, the subsidiaries' liabilities. Um, 36. So these.
Okay.
So that. I don't know why it. Black. So, if the liabilities and equity side only goes up by the liabilities,
Mm-hmm.
then this side's only goes up by the liabilities, but they have to balance. So now these will be the only one we're gonna get here is the lump total liabilities together. And the rest of these will just be the common stock. There is no additional paid-in capital. Some states don't require it for stock, so.
Mm-hmm.
That's it.
And they match.
Yep. Yeah, so that's kind of a little bit of an unusual one, just because the excess assets are
Mm-hmm.
negative for women, but yeah. That's another thing. Uh, I tell you what, let's get started from
Okay.
33. Then I'll let you try to finish it. Let's get all the basics.
Mm-hmm.
Okay, let's see. Corporation exchange 1,183,000 fair value consideration. So, I got a bird, dove sitting right outside the window on my air conditioner.
Oh.
So it's cooling. You hear the cooling. That's what that.
Oh, it's so nice.
Yeah. Okay. So paid consideration of 1,083,000. And sometimes you'll hear my well, you won't hear today, but like on Fridays you'll hear the apartment next door, they get kind of liquored up sometimes.
Oh my gosh.
Mr. Taylor, are you shooting out fireworks? No, I'm not shooting fireworks. Okay. That's gonna have a book value. I'm assuming that that book value is the net assets. Okay, so oops. Patent account was undervalued by 204,000.
Mhm.
That's only one, right?
Right.
Let's tell the so patent. Okay, so the net identifiable assets was 309. So we're going to compare what we paid. We'll do that. All right. So this, you'll notice, we paid less than the net identifiable assets.
Mhm.
So this is what they in the past would call bad will. In our case, we're going to call it a bargain purchase. So, oops. So we paid 126,000 is our bargain purchase. Let's give it its own color. You'll notice that they have already picked that up on the books. They picked it up when they purchased it. So we don't have any goodwill. We have the opposite.
Oh,
This is like
okay.
bad will's a bad term, but it's is a bargain purchase. And maybe this is why they bought the place. I mean, maybe they looked at it and said, hey, this is a deal. So they identified assets of 1,309,000. They only paid 183,000, so they have a bargain purchase of 1.6. And this is a one-time deal. So that's not going to happen every year. That's just one time. Whenever they make the purchase, all the assets are going to go on the books at the fair value. In the past, we used to write them down. They don't do that anymore. They say, okay, you get to show the bargain purchase. And going into the future, they'll say, okay, these will be on the, the assets will be on the books at the, correct fair value. So you won't look like you're more profitable because you have a piece of equipment that really costs 300,000, but you only have it at 250. You might look more profitable than you really are because you actually have more assets shown. Okay. I think that's the only wacky part. And obviously there's not going to be any goodwill in this.
Right.
So let's see. I'm going to copy this over. And no, you're not going to do anything with this bargain purchase. This bargain purchase will still be over here. And it's.
Can we just leave that alone?
Yeah, it'll be a positive. Your depreciation amortization expense is gonna change a little bit. How long do they say it's gonna be? 6 years? Oops. So this is 6 years. All right. And I will leave you with that.
Okay.
So when I do it, it'll be there too. And so next class, we'll go over this one.
Okay. Should I finish the chapter 3 packet then?
You know, we did up through it. You don't do, no, you don't do number 5 and number. I think this will be the last one we do for the chapter 3, though. I think you don't have to do handout problem 5, and you don't have to do text problem 3-27, which is a wacky.
Okay.
So we will, yeah. So what we'll do is just do text problem 3-33. Next class we'll do a practice exam, and then
Okay.
I'll have an exam on chapter 3, and I'll have to decide. What week are we in? Is this week 4?
I think so.
All right. Well, I'll obviously have to make a decision next week. There's 2 other topics we have to cover, and that is the foreign currency, which is not too bad, and then the governmental accounting, which is way wacky. So, yeah, I hate to leave you like this, but I'll because the other the next thing we would cover would be what they call non-controlling interest when you own 75% of it. And you know, so if you own 75%, someone else owns 25%. So you put 100% of everything on the books because you control 100%. Then
Right.
you subtract out 25% of the book value, basically, of the other one, which is a little bit kooky. But so I think, well, just for now, let's concentrate on this one. So we'll do these, and then one like 3-28. Next class we'll have a practice exam, and I'll send out the exam for chapter 3.
Okay, perfect.
All right. Well, have a good week, and I'll see you. Does Monday work for you, or is Tuesday?
Yeah,
better?
yeah. Let's do next Monday then, the 28th.
Okay. All right.
Perfect.
Great. All right. Well, have a good week.
You too.
right.
Bye-bye.